Uh, from a legal point of view, I do need to just suggest that today is a general advice forum. Anything that's personal nature, we will naturally talk to you about that offline from today's session. So on that front, I would like to hand over to Mirko, who's going to kick us off for today's session. And as I said before, if you have any troubles or we'd like to ask questions, please do so in the chat room, and I will pick those questions up and ask Mirko and Luke those questions as we're working through the session today. Over to you, Mirko.
Thank you, Shane, and thank you all for logging in. Testing times, no doubt, and you know, we find ourselves in a situation where a health problem has really now morphed into a major economic problem as well. I've found it very interesting that concerns have started to shift away from portfolios and economies back to health, welfare, well-being, families, safety, and the like. So it sort of shows us what the nature of the issue is and how large it actually is. In terms of the impact on investors, it's certainly not lost on us. The three people you see on the screen here, collectively, we have 60 years worth of experience doing this work, and this is probably one of the most testing times that we've seen during our investment career. So very difficult to now sort of be able to distinguish between the noise, the emotions, and the facts. But you know, our job as advisors is actually to be able to do that. Now we know that you know, for an investor, they're going to be looking for answers. Do we have all the answers? Unfortunately, the answer is no, we don't, because you know, no one does at this point in time. However, what we're trying to do is sort of say, how do we utilise that 60 years of collective experience to ensure that the decisions that we're actually making today make sense, and that you know, we don't find ourselves in a dire predicament. I'll share this slide with you guys, and I think we've all sort of seen the roller coaster of investor emotions in the past, and you know what the cycle is that we go through as an investor. We have this, you know, euphoric, you know, feeling great about my investment, to okay, a bit of a temporary setback, and you can't help feel that we're now sort of moving into this depression, panic, and capitulation type scenario. And what we're really trying to do now as advisors is say to clients, we need to be aware of where we sit in this cycle, and you know, and aware of our behaviours and what we're thinking. And sometimes the toughest decisions are actually the correct ones. Now, the toughest decisions at the moment is to try and stay on course, have the belief that you know, what's in place is appropriate for our needs. And if I can use the point that we've used with many clients, is that now is not the time to become a price taker. That's always our biggest concern, is that someone else is dictating what our price is. If I use the example of your family home, for example, if you know, a month ago we felt our family home was worth $900,000 and somebody's offering us $700,000 for it today, we have the luxury of being able to tell that person to go away, unless of course it's the bank trying to sell the house from under us. It's no different to any other investments you may have. We talked about BHP just online, then looking at the price before. You know, it was $40 a month ago. It was down to $24, $25, and today trading at, I think, $30, $20 or something. So we sort of look at that and say, well, if we've put valuations on businesses based on, you know, 10-year long-term forecast revenue potential, then we really should be sort of sticking to that. And we have a situation at the moment where sort of that panic and capitulation and that fear is actually driving the investment markets. It's actually not the fundamentals, and we're just sort of wanting to reiterate that to clients, that we want to try and stay the course, as difficult as it is. And again, I stress, this is not lost on us. This is very difficult for investors, and to Shane's point, we're certainly here for you to sort of talk you through this and enable you to sort of you know, get through this and try and ensure that we don't make the worst decisions at the worst possible time. We've seen how quickly the virus has spread, and it's that sort of exponential speed that we've seen actually going through the markets as well, right? So we've seen that the markets, you know, dropping off. If I look at some of the numbers, the ASX, the 200 off 31% since 21st of February. The US off 28%. That's off the back of this morning's close of trade. And last night we had a plus 10% day on the S&P 500. So looking at those sort of movements over a 23-day trading window is extraordinary to actually see that. There hasn't been an asset class spared. Fixed income and credit markets have certainly felt the effects as well. Listed property has. Cash rates have. The RBA moved the official cash rate down to 0.25 in an out of session move last week. So we're now sort of faced with where do we put our money? How do we position our portfolios? And it's certainly very difficult times in that respect. Even our Australian dollar was as low as 55 cents the other day. I think it's trading at about 59 this morning. And looking at that, we turned the new year 2020 at 70 cents in the dollar. So we've seen a 20% devaluation in our currency as well. So some of the things that I'd like to sort of cover off on today is three sort of points. How much structural damage will be caused by this crisis? How long will the disruption last? And what solutions are there, in response to everything that's sort of going on in that sense? So how much structural damage has been done? We know that sort of supply chains are definitely broken. We're not being able to access the goods and services as we previously have. We've all seen the panic buying, the queues at the supermarket and the like. And again, some of this has been behavioural that we've seen, and it's resonated in the investment markets without question. So supply chains from a point of view of the consumer, but also from the point of view of the manufacturer that's trying to get access to supplies to be able to do their jobs. The demand channels are also being compromised. So from people being quite scared at this point in time, scared to invest, scared to put their hands in their pockets, scared to spend money for fear of what's carried next. So, where that demand comes from is going to be a very difficult solution to come up with. I mean, one thing that is sort of in our favour is that with all this pent-up demand, when people do start to spend money, they generally sort of, unfortunately, we have this bad feeling they may start panic buying again, but we will see that released at some stage. When we look at the businesses out there, we know that it's going to be the cash flow sensitive businesses that are going to struggle the most. Unfortunately, so many businesses don't have contingencies. They run on very skinny margins, and quite often they're quite highly leveraged. So staying afloat is going to be a tough one, particularly for those businesses that, through no fault of their own, have woken up in the morning or at 9:30 after the PM speaks. They actually don't have a business today. They've actually had to send people home and lock the doors. And, we feel for those businesses. So there's going to be a lot of businesses that sort of struggle with this. Those that have the excess leverage, that have had that false sense of security about the value of their assets, they are going to struggle as well. And we sort of see that excess leverage starting to play out as we did in the GFC. Those that were highly geared, very difficult to sustain that at this point in time. Unemployment, we certainly expect unemployment will spike. We've all seen the queues at Centrelink over the last couple of days as a result of many businesses closing down. And that is going to be a major issue for us, where we've, be able to hand on heart say unemployment has been really low. We could potentially be heading to double figures in unemployment here. So, looking at the economy changing and evolving, we ask ourselves a question: where are these people going to be re-employed? I know that a lot of us are asking ourselves the question, where are my kids going to work when they finish their studies, depending on where they're at, in their stage in life. So these are the things that we look at and sort of go, we know that the damage is going to be significant, and we know that it's likely to be sort of long lasting in that respect, and we're very conscious of this. The second point I'd like to sort of raise is this notion of how long is this disruption going to last? Now, please, if anybody does decide to tell you that they know the answer to this question, I would stay clear of them, right? Particularly this bloke on the screen right now. He last night came out and said he thinks that we're open for business come Easter in the US. So we need to be very careful. We need to be very careful about making these sort of statements and the like. So our view of the world is that you know, we need to look at what's realistic and what the percentages look like. We look at three possible sort of scenarios. We're looking at a V-shaped recovery. So could we see a V-shaped recovery where we sort of bounce back pretty quickly with a quick resolution and looking at something that could turn itself around in 3 months? And when we sort of put a percentage against that, you know, with the outcome, and we take consensus here, we obviously take a lot of information from our sources, from our investment committee, from our outsourced partners, and there seems to be an outcome of less than 20% that we will see a very quick V-shaped recovery here. The other one is a U-shaped recovery that is more prolonged, and you know, that is looking like a 6-month play. And I think what we need to realise here is that for us to be able to fix the scenario economically, we certainly need to fix the scenario medically, right? And regardless of how things play out in the medical situation with vaccines, that takes time. So even if we're going to testing today, we know that we could be 3 to 6 months from actually finding a solution in that space. So, you know, looking at the U-shaped recovery, this is probably the most likely scenario when we look at what is being focused on out there, that we were likely to have a prolonged type recovery that will take more than likely 6 months. And when we put a higher outcome of that, probably more around the 50% mark. So, you know, unfortunately, we're talking about 50-50 type scenarios here. And the complete pessimistic view, the, you know, end of the world scenario is a depression type scenario, which this goes on for many years to come. And again, you know, when we look at that, we're sort of saying more than likely that's going to be like an under 20% scenario. So we'd like to think that we're going to see this U-shaped type recovery, that we're going to see this take sort of 6 months to start playing out, and that the recovery will take course. And I'd like to think that the same way that the markets have been belted in such a short space of time, that they're able to recover, not necessarily in such a quick rate of time, but in terms of a recovery. So, like I said, in terms of that type of solution, we'll need to see a medical improvement. Where are we taking our snippets of information? We like what we're seeing out of China. So I'm hearing that containers are now starting to arrive from China with goods that were manufactured in factories that are reopened again over there. So they sort of, you know, kicked off things in China back in December, went through this phase of a crackdown and trying to lock the nation down to try and stop the spread. We're starting to go through that scenario at the moment. So if we can take anything out of China, we'd like to think a similar type of scenario plays out here, providing that we don't become complacent. In terms of my third point, the solutions, if any, are available. The solutions are, as an investor, we're always looking at your portfolios, always looking to sort of say, have we ensured that we have enough cash so that we're not forced sellers? Are we looking at opportunities to sort of say, by rebalancing portfolios, will that provide us an opportunity to sort of reallocate our assets into highly depressed valuations? Our active managers are actively managing their positions, whether it's been through currency management, whether it's been through allocation to growth assets. So looking at those from an investor's perspective, we certainly have some solutions there, and we're not taking our eye off the ball from that sense. And the other solution that we're looking at is sort of a government response when it comes to sort of the monetary and fiscal measures that are available to us. And I might actually cross over to Luke, if I may, because I know he's all over the sort of the government response that we've seen, and I look forward to seeing some of your questions coming through.
Before we pass over, Mirko, and thanks for that, and Luke, if you don't mind, there's a couple of questions. You want to pick up a couple now before we keep going, and then we can get some more at the end, or?
Actually, Shane, what I might do,
yeah, sure.
actually respond to those questions as I'm going through, if you want.
Okay, that'd be great.
That might, I've just seen a couple that have been asked, so I'll be able to probably just come in on those ones as well. So I'll keep it on. Just make sure if I've missed something, just let me know, yeah?
Sure.
Beautiful. One thing, before I proceed any further, I guess, our sincere thanks to every one of our clients. I don't think we could ever thank you enough. It is what an incredible time, and we're actually living history as we speak, which is an amazing time to be alive in terms of, as frightening as it is, it's also just sheerly amazing because we don't know what's going to happen next, I guess, to a certain degree. But the amazing scope of our clients to sit back and ask how we're doing and how we're feeling and how our families are coping is wonderful. So for everyone who has expressed care for us, thank you. We're doing wonderfully well. We're okay. We're all healthy. We've made arrangements for our team to be healthy as well. We've made arrangements for our families to be healthy. And that commitment is all about serving you, our client, to the best of our abilities, and we will continue to serve you as long as we can. From a financial point of view, the good news is that the business is also in an extraordinarily strong position as well. So we don't have any concerns around our viability from that point of view, which is a fortunate thing. So look, we're here for the long term. It's a promise we've made you from the start when we first met you, and we'll keep on doing it all the way through. But in terms of the solutions, in terms of what, if any, are available, I guess, and what we are dealing with today is a health crisis, which has now morphed into an economic crisis. And what is clear is that monetary and fiscal policy in their traditional formats are not actually equipped to deal with such an issue. And the crisis itself is probably going to require a different level of thinking. And I guess it's tandem to, if we can imagine the government putting in a firewall between what the current disruption is and what the future consequences will be. And I guess if we explain it differently, if we remember up until about 3 weeks ago, the focus of the government was very much still on surplus, and it was still much on paying back the deficit, and it was very much on staving off recessions. The good news is that's all gone out the window. We genuinely don't care about a surplus anymore. We genuinely don't care about a deficit anymore. And the concept of a recession is a fait accompli. So with that being the case, we're actually now worried about keeping people healthy. And that's all that matters, keeping people healthy. So in saying that, by keeping people healthy, we're going to make decisions here which are going to have downward economic consequences later on. So if you spend a lot of money now, eventually that money will need to be recouped or repaid for or whatever. But ultimately, we're worrying about now, not tomorrow. So what has the government done to date? I guess, well, a couple of things. If we saw overnight, and the reason why Wall Street had gone up so heavily is that we saw the Republicans and Democrats finally put their issues to the side and actually worry about the American people. And, you know, bizarre that they would actually worry about the people, but it was kind of nice to see that they announced a $2.5 trillion bailout. Now, trying to wrap your head around what $2.5 trillion means is just a crazy amount of money. Now, by way of comparison, the Australian government has pledged $186 billion. Now, I'm not sure about you, but that kind of feels a little bit light on at the moment in my world. So the way I'm kind of looking at that is, I think the government needs to get credit for what they've done up until now, but I think it's fairly clear, and Scott Morrison, to his credit, he's recognised that and said there's a lot more coming from that point of view. Now, conscious of time, the government has announced a number of initiatives, and rather than try to go through each one independently and explain the nuances of each, what I've got to do is I'll just give a high-level view of what these things are. I'll also then try and address some of the questions that have been raised. But the key there is, I guess, if there is something that you think may impact you or something that you may think that you may be eligible for, I would encourage you to speak to your advisor. That's what we're here for. And I think Shane eloquently put it, it's 24/7. You've got our numbers, you've got our email addresses, you've got our ugly faces on this wonderful technology that we've got in front of us now. Feel free to use us as much as you need to at this moment in time, because the more information you have, the better decisions you can make, which is important. But in terms of some of the initiatives is, from a superannuation point of view, for those who are experiencing financial difficulty, the government has allowed for early access of superannuation. So you'll be able to access $10,000 in this financial year and $10,000 in next financial year from that point of view. Now, to be eligible, there will be certain requirements that you need to satisfy to do so. But whilst this is a really great idea initially, and for retirees or for people who are approaching retirement, I think it's great. For our younger cohort of client, I think it is quite dangerous in terms of a decision now to take money out of superannuation will have a long-term impact in terms of the compounding effect as well. So it's just something we need to be mindful of, and it's something we need to plan for, and it's probably the last thing on the agenda that we want to consider. The other things that the government have introduced is they've adjusted the drawdown factor rates on account-based pensions. So that's really important for our clients who are drawing an income stream from their superannuation at sorts. So at the moment, many are being forced to draw down a particular amount of money that they may or may not need. For the ones who need it, that doesn't mean anything. For the ones who don't need it and are having a surplus, well, this is a perfect opportunity for you to now reduce the amount of drawdown that you have. So that's a good result. The government has also introduced tax-free payments. So they'll be paying $750 in 2 tranches for people who are in receipt of a government benefit or a pension from that point of view, and also people who hold eligible concession cards, and that includes Commonwealth Seniors Healthcare cards, low-income healthcare cards, and pensioner concession cards. So what it'll mean is you'll get paid $750 pretty much now, and you'll get paid another $750 in the next quarter. From that point of view, thereby meaning you'll get paid $1,500. And if you're a member of a couple, that means, and you're both on the pension, you'll both get $3,000 coming into the house, which is kind of cool. For people who are on job seeker, youth allowance, Austudy and those sort of things from that point of view, or parenting payment, you only get paid once, not twice. So the government, for all its nuances in terms of saying, well, we've got to help the world, that argument about, well, hang on a sec, we don't want to give people who aren't working a free kick too much. They're running that mantra still, which is a bit unfair, I think, from that end. But we won't argue at this moment in time. I guess whilst this initiative is good, my concern, however, over the shorter term is when people are scared, they won't take this money and go out and spend it, which is what this thing is designed to do. The government is hoping that people who receive the money will go out and spend it. Our experience tells us when people are scared, they tend to hoard. And when they hoard, they don't spend, other than buy toilet paper if they think that's a good idea, but from that end. So yeah, we're just going to be mindful of that. The other thing that happens, and I noticed there was a question around damming rates. Yes, sanity has finally prevailed. The government has reduced damming rates, albeit this reduction is minor and virtually insignificant. The government is well behind the 8 ball on this one, and we would like to see further moves in this space. But in fairness, yes, they have reduced it by an additional 0.25, so that's a bonus. But the reality is, with the incomes test and so on, it's not going to provide much joy, I don't believe, from that point of view. The other thing that the government is allowing for, or Centrelink is allowing for, is for clients who are in receipt of an account-based pension and are impacted by the assets test. Centrelink is allowing for clients to update their account balances. Obviously, their account balances have fallen in the current market, and they're allowing for clients to update their account balance, therefore showing a reduced amount, thereby causing their pensions to rise. For clients in that space, we're already doing that work for you. So if you're wondering about anything like that, that is something that we do on your behalf, and we're actually doing that work as we speak. So hopefully we'll start to see some flow where Centrelink, your pensions may increase for those who are receiving those sort of things. In relation to the benefits for business, obviously the government has introduced asset write-offs, and that was always in play, but they've now increased it to 150,000, which is an extraordinary amount of money. The only problem that I have is, great idea, but if we do move into lockdown, you won't be able to apply for it. So it just kind of doesn't make sense. So it sounds really good in paper, but in actual fact, who is able to use it, I'm not sure. The other thing that the government has also done, and this is to their credit, is cash flow support. So the cash flow support is where a minimum of $20,000 will be paid to eligible businesses, up to a maximum of $100,000. Now, this essentially relates to people or businesses that are companies and that employ people. So a wonderful initiative. It'll do a lot to keep businesses afloat. I would encourage people and business owners to get in contact with us, and we'll be able to guide you as to whether or not you are eligible or not from that point of view. Where this thing does fall over, it does do nothing for people who are sole traders or micro businesses. So in your regard, there's really no initiative there other than for you to look at the job seeker allowance from that point of view. Another thing that the government has also introduced is for those sole traders is the ability to apply for things like job seeker allowance. And they've also doubled the amount of payment that one would receive on job seeker allowance. So previously the job seeker or the New Start allowance was $550 a fortnight, which was well below the poverty line. They've now doubled that allowance to $1,100 per fortnight. However, whilst that sounds fantastic, it is really difficult to apply for. So just be aware that if your kids or people that you know are impacted by this change, there's going to be a lot of frustration there. Because the government, I think from what I can understand, the MyGov site was designed to carry 100,000 people at any one time. And in the last 2 days, 1.5 million people have tried to get on it. So it is quite staggering in terms of what's going on. The state government, to its credit, has also introduced a payroll discount. So the payroll discount is for businesses who have payroll obligations of less than $3 million. So all their payroll that they've paid up until now will be refunded, as well as whatever they needed to pay in the next quarter. So that is a common sense, a great initiative by the state government, and credit to them. However, one would hope that sanity will eventually prevail. Why on earth we pay taxes to employ people defies absolute logic. But this is what you get when stupid people make stupid laws. So we just got to be aware of that. The other one there is the apprentice and training subsidies. The government has also introduced the ability for wage subsidies of up to 50% for eligible employers and eligible employees. For this to apply, the apprentice must have been employed on the 1st of March 2020. So again, any business that is impacted by that, please get in touch with us from that point of view. And I think the final one, and this is probably a real common sense one, is the change to solvency rules. Under current law, one cannot trade insolvently, and if you do, you're actually in breach of the law, both from a company point of view and both from a director point of view. Obviously, with cash flow being absolutely critical at this moment in time, the government has relaxed those laws as well, which is a win for common sense. So I guess when we start to think about all these things and we ask ourselves, where has the government come from? The government does deserve credit for what they've done up until now. And I'm not sure who watched last night's press conference, but I thought Scott Morrison, in difficult and trying circumstances, is trying to put his best foot forward in a world which is absent of a playbook. So it's really hard to make decisions very quickly, and it's really hard to make decisions, particularly in Australia, where we have a federal government and then we have state governments from that point of view. That being said, there's no question that the government needs to do more. And possible options include industry-based interest-free loans, tax-free holidays, debt guarantees, and central banks getting involved in commercial paper and perhaps even buying equities to a certain degree, and things like the Future Fund buying equities from that point of view. So if the Future Fund is sitting on excess cash, might support the market from that end. Other initiatives include, and this is probably more than the socialist route, I guess, where banks actually don't charge interest rates on their loans. So businesses who own money, people who own money on their homes and so on, that they actually provide a 6-month moratorium where no one actually pays any interest. Now, one of the interesting questions that we've had online here is that, do we need to be worried about the banks running out of money? At this moment in time, I would suggest no, and I would say absolutely not, purely because they are government guaranteed. The government does provide a guarantee to the banking structures up to accounts of $250,000. So from that point of view, we don't have that concern at this moment in time. Again, this is a health crisis, not an economic crisis. Other things that may also happen is we may see landlords providing rent-free periods from that point of view. And other things that we may also see is utility companies actually saying, no, you don't actually owe us any money for your bills. What is clear is that not one entity can fix this problem. This entity or this problem is going to require multiple parties to share the pain. So we're all going to have to be involved in the hurt, so to speak, from that end. So in terms of, I guess, where we're at, unlike the GFC, which happened in 2008 and previous crises, a lot of those crises were always caused by an industry or a particular business doing something incredibly wrong, and it caused a knock-on effect. This particular situation is not that. This is a health pandemic. With that being the case, the moral hazard that the government usually has a problem with helping out the economy at times like this, because the government will normally say if people have been misbehaving, for them to come in and act would be inappropriate because it would set a standard. In this particular case, obviously, we don't think that's going to be a problem. And the rhetoric we're seeing from the government is actually the right rhetoric. We're worried about human life and we're worried about protecting our citizens first and foremost, and the economic consequences are now coming second. So when we start to piece all this together, what it should do is provide you with a sense of confidence to sit back and say, well, okay, they're not just leaving us to our own devices. Is the information that's flowing out of the government slow? Yes, but it's also understandable given it's such a fluid situation, and it's difficult to actually make recommendations when those recommendations can change within an hour of coming up with a solution, so to speak. But that's where that kind of sits at the moment. In terms of what does this mean on a broader concept, and I'm just looking at a couple of the questions there. In terms of the rental market, in terms of where we see house prices longer term, at this moment in time, the current impact, I don't think is going to have a massive outcome for the property market today. However, if we start to see unemployment uptick, which we will, and if that becomes a more consistent number where all of a sudden unemployment rates sit at above 10 or closer to 15, and we've seen some numbers like that bandied around, the natural consequence of that is that that will have a deflating impact on property prices. Now, if property prices were to fall, that would then cushion the blow of rents having to rise from that point of view. But it is one of those situations where at the moment, house prices have remained pretty stable purely because they're static in nature. The reality, however, is I think, is that as we start to work through the cycle here, that we could see some pressure coming there. I'm not sure, Mirko, do you want to add some point to that?
Yeah, I was just going to say on the property market, just an illustration of how unique the times are. Last weekend, when all this was going on, the auction clearance rates were through the roof, and people were trying to decipher why that was the case. And a lot of people were buying up properties because of fear of not having somewhere to be in isolation. So the sort of the thought process that's been going on in terms of the property market is quite unique. And last night, Scott Morrison made the announcement that there'll be no more open house inspections, no more auctions. So what does that do to the property market, and how do we sort of react to that situation? I think in the late 80s and early 90s, when we saw the property market come off, and a lot of people have sort of put that in the dark past and sort of looked at, oh, these things don't happen. Well, it happened in a big way back in the 80s and 90s, but we did have a unique set of circumstances. Unemployment was really high, which we have a chance that could happen now, but interest rates were really high. And the opposite effect is at the moment where we don't have such high interest rates. However, households seem to be a hell of a lot more leveraged than they were back then as well. So, the property market generally has a significant lag, and as you rightly point out, Luke, they're not things that we revalue every day unless the hammer is dropping at the time. So I think that, in the shorter term, we'll probably see the prices sticking the way they have been. But longer term, if we see structural issues with unemployment and we keep seeing those lines at Centrelink, and that at some point in time, something's going to give, and some of those poor homeowners are actually going to become price takers, which is, what we're talking about, not happening for them. I might just pick up one other question, if you like. Shane, I'll bounce back to you. I saw much earlier on someone asking the question about have we reached the bottom, as far as the investment market. So I would be a very brave person to answer that question and sort of go, yes, we have. All I can say is that we're 30% closer to the bottom than we were 21 days ago, unfortunately. But look, we're going to see rocky times like this, and we're going to see ridiculous moves in markets in a single night, like we did last night. Last night we saw the US go up 10% in one evening. I don't expect to see those moves. If I sat down with you at the end of 12 months and said the US market did 10% over the course of the year, you'd probably say, yeah, okay, that's not a bad year. But to think that we could have a move like that in a single evening, that's what we're talking about. So as an investor, I always say this, not a market you want to be in or out of, for that matter. For the guys that are in it, they're suffering the volatility. For the guys that might be out of it, they're sitting on the sideline saying, well, when do I get back in? And what is the right time? And data tells us that trying to time it is impossible and can only lead to tears.
I think the other thing that we might want to raise there, Mirko, in terms of the signposts. So if we turn around and say, well, when would we know that we're close, or when would we? And I think the key there is, in the absence of a discovery of a vaccine, and even if a vaccine were discovered, because of the way the process works, so we've got to go through testing requirements and so on. We can't just put it out there, so to speak. That's probably about 12 to 18 months away in the vaccine piece. So I think one of the clear signposts that we'd be looking for is for the number of infections to start decreasing. The interesting thing, and I think why the market has been a little bit more buoyant, particularly yesterday and today in particular, is that the numbers in Italy, which were horrendous over the weekend, have actually started to show that they're actually starting to decline, or the number of infections. So they're still in a world of hurt, still in a massive world of pain, but the number of infections are starting to decline. So what that actually is showing is that this thing of social isolation actually does have some scope. So I think what we're going to start to see there in relation to that particular question is when we start to see things starting to fall and things starting to become a little bit more predictable, I think that will be the close to the bottom bit. In terms of, I think Mirko's point in terms of where we're at this moment in time, the sheer swings and the magnitudes of these swings are going to continue for a little bit longer yet. But I do think the key with a lot of the portfolios, and it's really important to remember this, when we designed or when we've designed your portfolios in all your particular affairs, we focused on three things in particular. We focused on absolute quality in terms of asset. We focused on ensuring that we invested as per a mandate. So if there are income requirements and all that kind of stuff, we made sure that we quarantined sufficient monies to the side to make sure that you would never be a forced seller in markets like these. So that was really important. And I think the third thing that we also focused on was diversification, or the principles of diversification. So not only do we spread you across asset classes, but we spread you within those asset classes and then across specialist managers. Now, combining these three factors together serves as a way to protect you. Now, it can't insulate you entirely. I wish we could do that, but we can't do that. But it does serve to protect you as much as possible. And more importantly, and this is really important as well, whilst at the moment it feels like we're just going down and all that kind of stuff, a lot of the specialist managers that we do engage are actually repositioning the portfolios as we speak. And in repositioning the portfolios, they are getting ready for that eventual rebound. So when that rebound comes and the market might bounce back by 20, 25%, 30%, who knows, then hopefully then portfolios might bounce back 40, 45, 50 because now they're in the right areas, if that makes sense. Shane, back to you, mate.
There's a couple of questions here I might ask,
And by the way,
happy for either of you answer.
go for it, mate.
Sure. Well, all I would say, I'll ask a couple of questions, but I think to your point, Luke, a moment ago, you know, we're dealing with a situation which is raw at this stage, and the liquidity of client portfolios and available cash, I think, is such a critical component. And I feel as though one of the key conversations I've been having with the majority of people, some in this room, is exactly that part, making sure that we have enough cash in portfolios, because that's the part that we can control. And controlling that is a great thing in the short term. It gives us time to work through this. And I think, you know, now more than ever is a point to check in on that with your advisor if they haven't done so already. So I'll pick up a couple of questions here. I'll pick up one from Adam. It says, great opportunity to rebalance to the asset allocation designed for clients. I totally agree in that regard. And that's exactly to Luke's point there, is that what seems like a crazy thing at this point in time in putting more money into equity markets is probably the best thing to do over the medium term. You know, we wouldn't be suggesting that we do it all in one hit or all at the same time, but through these very volatile times, actually adding more money into the markets and consistently maintaining that asset allocation is what will help the portfolio most definitely when the market does turn. And you know, going back to that point about cash before, we don't know when that market's going to turn. So as long as we've got enough cash in our reserves to work ourselves through for, you know, a year or two, then we're going to be okay to keep going down the path of rebalancing from that end. We've got a couple of questions here about property market again, in relation to if property falls and the banks take a hit, how does that sit from a banking stability point of view and their liquidity? Any thoughts on that, Luke or Mirko?
I wouldn't mind. I guess there's two things. One we do know is that the government provides a banking guarantee of up to $250,000 per account. So from that point of view, that removes the risk of the banks falling over, so to speak. The second issue there is, as we saw in the early 90s, what the banks will do is, rather than foreclose on mortgages, they will just they will actually absorb that stuff within their balance sheet. So we saw that during the GFC in the US in particular. So rather than foreclosing, banks just held assets which were now undervalued, effectively from that point of view. Now, what that'll essentially mean is that it'll cause a devaluation in bank share prices. So as opposed to the banks recovering with the broader market, and for example, National Australia Bank might be down 50% today, so to recover it needs to go back to its original position. It may not recover to its original position purely because of those impairments. So it's just something we need to be aware of I guess, in that space. Should we be worried about the banks at this particular moment in time? No. Should we be thinking about this as an amazing opportunity from a property point of view? Probably not at this moment in time. You'd want to be holding back at this end, because I think at the moment we're dealing with so many unknowns in that space. We just don't know what 3 months or 6 months is going to look like. And it really comes down to, I guess, to Mirko's point earlier today, is this a V shape, which I think we've all considered probably not. Is it depression? And we've all probably considered there that it's probably not a depression type scenario, because we're talking about 3 to 5 years worth, and eventually, we are moving out of the northern hemisphere winter and coming into our winter from that point of view. So there are some green shoots there. So it's probably a U in terms of the type of recovery. As to how long that U will last will determine what happens next on the property piece. So, like I said, I think from a bank's point of view, we're okay. Property point of view, we're kind of sitting here going, yeah, I'd be a little bit cautious before I'd be committing in any regard there. Mirko, do you have any view there?
Luke, I was going to say, Luke, if you don't mind, if I can add something to that end. I mean, I find the psychology of investors really fascinating in times like now, because some people see opportunity, some people see fear, which is what makes the market so special.
That's right.
What I would encourage anyone who's thinking about investments or anything of that kind at this point in time is to make sure you check in on your objective and understand what the context of that investment is first and foremost, and work through cash flow in your own world, so that before we go and make a decision which is based on opportunity or based on fear, that we're doing so with the right context first and foremost. And I think when investors try and remove emotion out of the decision making to start with and do so with a clear mind, we always feel as advisors that we land in a far better place for doing so. I might pick up another question, which I think would be a good one for you, Mirko, if you don't mind. There's a question coming through about, do we foresee inflation or deflation considering the extreme amount of QE? So for those who don't understand what QE is, basically the governments of the world just powering money into our economy to try and keep it afloat, which has some positive and negatives. But Mirko, do you see any issues from inflation or deflation with that serious amount of money, given this is probably a first time for many years that we've seen a collective from governments around the world rather than one or two countries throwing money into their economy? What do you see in that regard?
Yeah, that's a terrific question from one of our attendees. The recent change from the RBA in terms of the QE, this is a new one for us, where they're sort of virtually printing money so as to go buy back government bonds to try and stabilise the bond market in that respect. There's been some cases for both inflation and deflation. I think where we sit right now is that we'd actually be hoping for some inflation, because it would actually indicate things are sort of ticking along quite well. But we're starting at a really low base. If you look at the RBA website now, pretty sure it reads 1.8% is our inflation rate. Okay, so from that point of view, I think we started at a really low base. I don't see a risk of inflation blowing out. However, when we look at the sort of deflationary potentials, having this systemic reduction in prices throughout our economy, I can't see that occurring right now, despite the fact that there are asset classes being impacted on that. So I'm not as nervous on inflation, deflation in the economy at the moment. Like we sort of maintained here at the moment, we're dealing with a real health crisis now, which is playing out as an economic crisis as well as a secondary situation. So I don't have a concern there. Just while I've got to the floor on the inflation piece, this has been a really interesting one. So inflation at 1.8%, but we all know that our household inflations are probably more like, 7 to 10% in real terms, when you look at the cost of living and just the cost of paying the bills and the like. So all of a sudden, we've actually got a cash rate of 0.25. RBA telling me that my inflation's 1.8. I'm telling the RBA, mate, it's 7 to 10 in my house. I don't know where you guys live. So we're looking at it and sort of saying, is simply sitting in cash a solution as well? And again, it's another dilemma for clients where the cash rate is actually less than the inflation rate from that perspective. So it's important that we sort of look at our portfolios and sort of concede that over time, I can't sit in cash for too long. I can't sit the predominant of my assets in there, because I'm actually going backwards at a rapid rate of knots. Now, one might argue it's a less rate of knots than I would have over the last 3 weeks, but we can't look at it over a 3-week cycle from that point of view. So, yeah, great question about inflation, deflation.
Thanks, Mirko. And look, there's a couple more questions coming through, but before I pass on the next question, which I'll think is a good one for Luke, if you've got any more questions, please send them through the chat room. We're doing our best right now to try and answer all of them. But any more questions, please fire them our way and we'll pick them up. There's a question here, Luke, about, I guess right now there's a whole lot of panic around the coronavirus and possible shutdowns that may come as a result of that. Do we foresee any systematic knock-on down the track to corporates that may have debt and sort of suffering on the back of shutdowns?
Yeah. Okay. Look. That's a very real risk, and I think it's an awesome question in terms of, and we could probably spend the next 2 hours discussing and debating it in truth. But I guess from where we sit, and there's if we look at the situation today and we look at the situation back in 2008, and I think this is where we probably need to look at it. In 2008, we entered into the GFC. Corporate Australia, corporate USA, corporate Europe was in a lot of trouble. They were highly leveraged in many cases. They had limited cash in their banks, and their cash flow was quite sparse. So from that point of view, and they entered into the crisis in very bad shape, which meant that the government had to come out and save a lot of these companies and a lot of these industries from collapsing. In this particular situation here is we've actually entered this crisis in a completely different position. A lot of corporations are actually not leveraged or carrying significantly less leverage than what they were any time in their history. More importantly, they are sitting on significant capital savings or cash savings. And more importantly, they've got strong cash flows. What we're finding is that the shutdown is going to affect more smaller to medium-sized businesses, in truth. And in particular, a lot of the ones that are service delivered. And what I mean by service delivered is where people need to see each other face to face and they need to be present. Today, we have the privilege of speaking to well over 100 people. And we're being able to talk to you in this manner and we're able to communicate. So we're doing it safely. We're doing it the way it should be done in the current environment. So what it means is corporations like us and other organisations out there, particularly the larger ones, are probably not going to experience the complete shutdown because they still will be able to operate. In saying that, however, a bad business is a bad business, and ultimately there are always bad businesses out there, and there will be the odd firm that won't be able to recover as a result of this. But I don't believe it's a systemic issue where we kind of go, well, hang on a sec, we've got a real problem here, Houston.
Just on that point, if I may, Shane, Luke made a good point about the corporates being in much better shape. We've had quite a few questions about the banks and how viable they are, particularly if the property market comes off. One of the things that we do know is that the banks are in much better shape going into this point in time than they were during the GFC, right? Which, and if you recall, Australia was, as a result of the banking deregulation and the tears that we felt in the 80s, we were actually much better shape during the GFC. They're actually in much better shape today. And I've found it very interesting to see the mindset changing with regards to the banks themselves and the responses that they're getting. I don't know if anyone saw an interview with Shane Elliott, the CEO of the ANZ, and someone was asking him about, small businesses that are going to struggle with repaying their debts and the like. And he just blanket came out and said, we have no interest in having people lose their homes because they can't repay their debts as a small business, which I thought you probably wouldn't have heard that 10 years ago. That was the feeling that I had on that. So I think that there's no benefit to the banks of forcing people to the wall. I think that now the mindset is more that they're going to try and work with people. And, someone asked a question in here about the bank bailouts and the bank bail-ins. Now, the bail-ins, for those of you that aren't aware, is where the banks use investors' money, depositors' money to save themselves from that point of view. I don't see a huge risk of that. I see our banks in good state. And my throwaway line is that, if we've got a real concern around our big four banks, then there's going to be a hell of a lot more to worry about in terms of where we are at with this current situation.
Yep.
Thanks, Mirko. I might just, in the interest of time, we've got about a minute or so left to try and keep the session to an hour. We're happy to stay for as long as needed. But there is a comment here which I think is a good one. We're all across small businesses and the like. And Mirko, your point there about the banks, I think maybe the half glass full side of me suggests that perhaps there is an opportunity for the banks to rebuild a lot of trust that they have lost in the last 12 to 18 months. So I certainly hope that they do use this opportunity to rebuild trust in the community. But there is a good comment here about small businesses and what they should do at this point in time. I think the answer to that is that be prepared is what I would say. So if you're in business, or you've got kids in business, or you've got family in business that are in a small business particularly, we are likely to see a cash flow issue in the short term. So our advice is certainly around that front, to be prepared, plan, and in doing so, I certainly feel that you'll be better off as a result. So there aren't any more questions in the chat room, so I might take this opportunity, if you don't mind, Luke and Mirko, to thank everyone for their attendance today. We've had some nice thoughts here saying people have really enjoyed the format of being able to ask questions and how regularly we intend to do this session. Our intention at this stage is to do this weekly, 12:30 every Wednesday, to keep running this, so you can see us on the screen, you can ask us questions. We hope you've kind of enjoyed the rawness of our meeting or session today. We like to come across real and human, as we do when we're meeting with you one-on-one, face-to-face. So we hope the computer has been as kind. I can't speak for myself, but Luke and Mirko definitely have a head for radio, not so much for these online sessions. So, so on that front, I will say thank you all. If you do have a moment, we'd love any feedback that you've got for us, good or bad. We'd love to hear it. We'd like to make sure we make these sessions as on point as we can for you. So please put any good or bad feedback in, and we'll certainly endeavour for next week's session to adapt our style so that we do the best we can for you. So once again, thank you all for taking the time to listen to us. We're here with you for this journey, and as I said at the start, and Luke reiterated through there, at this point in time, 24/7, please do not hesitate to call us. We're here to help, and we have no doubt at all that working together through this will come out the other side better for the experience. So thank you, everyone, and we look forward to speaking with you in the short term, and then again next Wednesday at 12:30.
Thanks, guys. Have a wonderful
Good day,
week.
guys. Bye-bye. Take care.